Top 7 types of investment strategies. The passive strategy involves buying and holding stocks and not frequently dealing in them to avoid higher transaction costs. On the other hand, active strategies involve frequent buying and selling. This is also known as growth investing. The holding period also depends upon the preference of investors. The idea behind investing in such companies is that when the market goes for correction, it will correct the value for such undervalued companies, and the price will then shoot up, leaving investors with high returns when they sell. This strategy is used by the very famous Warren Buffett. There are 2 types of cash income which an investor can earn. First, dividend. And second, fixed interest income from bonds. In this type of investment strategy, the investor looks out for companies that consistently paid a dividend every year. The investors reinvest such dividends and benefit from compounding over the long term. The downtime in the stock market is usually at the time of recession, wartime, calamity, etc. However, investors shouldn't just buy stocks of any company during downtime. They should look out for companies that have the capacity to build up value and have a branding that prevents access to their competition. Indexing. This type of investment strategy allows investors to invest a small portion of stocks in a market index. These can be S&P 500, mutual funds, exchange-traded funds. Those are generally seen as the safest investments. This was just a quick summary of the most used investment strategies.